Alrighty. Hi everyone, welcome to today's webinar, Know Your Numbers. My name is Ross Corcoran and I'm a Director at Dot Advisory. I'll be your moderator today. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. Let's take a quick closer look at the controls. If you scroll to the bottom left of your Zoom screen, you'll see a microphone which will provide you the ability to change your audio settings as well as a video, but we're going to politely mute everyone today to allow the panelists to talk. In the middle of the screen, you'll see a question and answer option, which you can see here on the slides as well. Up there, you can post any questions you'd like to ask along the way. I'll do my best to respond to any simple ones, but if I feel there's some questions that are worth entertaining with the whole group, we'll hold those until the end, and Warwick and I will answer those then. Click leave the meeting at the bottom right at any time if you need to. The webinar is being recorded and that recording will be sent to you. Just a quick one, there'll be a feedback form at the end of the webinar that we're hoping you can all fill out, just so we get some feedback to continue providing good content for everyone and improving them as we go. I'd now like to introduce today's presenter, Warwick Maddox, my fellow director here at Dot Advisory. Between us, Warwick and I have over 20 years of experience working with small business owners and advising them through their journeys. Warwick's true passion is to help people understand their numbers, to pull out the insights they need to help grow and improve their businesses constantly. So welcome, Warwick. I'll now hand over to you.
Thanks, Ross. Good to have everyone here today for our Know Your Numbers webinar. So what I'm going to do is, so you don't have to watch me speak for the next 30 or 40 minutes. I'm just going to turn off my video and we can get into the content. So we'll start off with a thought of the day just to get everyone into the right frame of mind. So Jack Lew, who was a Treasury Secretary in the US, said the budget is not just a collection of numbers, but an expression of our values and aspirations. What we're talking about in this webinar is about demystifying some of the common reports that you see in your business on a weekly, monthly, quarterly, or annual basis, so that you can be in control of your business performance. So the agenda for today, we'll go through why you need to know your numbers, an overview of the common financial reports, the difference between profit and cash, which is a common question we get as accountants, the key drivers of business value in your business, how to protect our assets, adopting best practice business management and governance, and some next steps. And then, as Ross mentioned earlier, we'll have a bit of question and answer time at the end. So if you've got any questions, please post them through the Q&A section, and Ross will collate those for discussion at the end. So why you need to know your numbers. So firstly, the financial figures in your business tell the story of your business. It allows us to understand where you've come from and allows us to interpret the results of the hard work we're putting into our business. It also helps us to identify the symptoms within the business, the challenges we're having, and the root causes of those problems or challenges. For example, a decline in gross profit is a symptom, or it could be a symptom of ineffective pricing, rework, depending on what work you're doing, or wastage. Further to that, understanding our financial figures allow us to identify early warning signs of potential issues. Now, we all hope that our businesses don't become insolvent or have significant issues, but if we're regularly reviewing our financial reports, then we can identify the early warning signs of those issues before they become bigger issues. Also, areas of strength within our business and areas of weakness. So we focus a lot on weaknesses and how to improve those in our business, but it also is a good example of celebrating our strengths and the good parts in our business, what's working well. Probably most importantly, good financial reporting and review helps us to make better decisions. So if we've got good data and we're translating that into good information, then that allows us to make better decisions for the future of our businesses. And finally, we all know that knowledge is power. So the more we know about our business, the better our business will be, and the better decisions that we're making. So the key reports we're going to go through today is the trading account, profit and loss, balance sheet, statement of changes in equity, depreciation schedule or fixed asset register, and our shareholder current account. Now, some of these reports you will be comfortable with and will have seen them many times in your businesses. Some of the other ones you may not have seen much or at all. So we'll go through those. And we'll use the example of a fictitious company called Foods Co. For the purposes of showing how these reports work. Now, take the fictitious company Foods Co. with a bit of grain of salt. It's, as you'll understand as we go through the figures, it's not doing so well and does need to turn things around a bit. So we'll show you that in more detail. So first of all, the trading account. So the trading account is the area usually at the top of our profit and loss that shows our sales, our variable costs, and our gross profit. And it's a good indication over time as to whether our gross profits or our margins are improving or declining. And therefore, we might be making more or less money on each sale, each dollar of sale in our business. And what you'll see in the example that we use soon is that small adjustments in the trading account can have quite a significant impact on the overall results. So we'll show you an example of that now. So this is the trading account for our fictitious company Foods Co. You can see here that our sales is just over $1 million. We've got variable costs or total costs of sales of about 318,000, which gives us a gross surplus of the difference of just under 700,000. Now, there are a few or fairly substantial direct costs, and direct costs are anything that's directly attributable to selling that product or service. So things like delivery costs and packaging, sales commissions and the like, which those costs are only incurred if we make a sale. So you can see here in this business, we've got a gross profit percentage of about 24%. So that means for every dollar of sale that we generate within the business, less the variable direct costs for those sales, we retain about 24 cents in the dollar on those sales. Now, if we were to go through and just make say a 10% increase on our sales, so we can either do that by selling more product or service or increasing our pricing. In this case, what we've done is we've actually done a price increase because you can see the cost of sales have dropped as well, rather than going up 10%. So if we maintain or manage our costs, you can see that the gross profitability at the bottom has increased from 24% to 35%. So 5 and 10% aren't big percentage changes, but from a dollar term, they can make a significant impact on the business. And you can see there the gross surplus has increased by 140 grand in this scenario. Now, the profit and loss, most business owners will be comfortable with a profit and loss report, but the idea or the goal behind the profit and loss is to track our overall performance and matching of the income we're generating versus the expenses that we're incurring over a given time period. And it's a good way to benchmark our performance for, say, last financial year to the financial year before, or month to month, to see where might be some seasonality in our businesses as well. Given this is a food manufacturing business, in our fictitious example, there may be seasonality in a business of this nature. And at the end of the day, a lot of the valuations of businesses are based around profitability. So in terms of valuing a business for potential sale, the profitability is one of the, if not the most important component. So in terms of the profit and loss, you can see that the gross surplus is the amount coming from the trading account that we mentioned earlier. And then we've got a bunch of expenses. So in this case, depreciation of $57,000 and rent of $57,000 are the more significant costs in this profit and loss. And they've also got a lot of utilities, bills, heat, light and power, etc. So they've clearly got a physical premises or physical presence where they're manufacturing foods. You can see here the total expenses are just under 300 grand. And when you deduct that off the trade surplus that we saw earlier, you can see that there's a loss of about $50,000. And then we've deducted the shareholder or the owner's salary as well. So when you take that into account, there's quite a substantial net loss in this business. So this is a business where we'd need to look at changing some elements to improving this business. So if we make some small adjustments, so say for example, we negotiate some lower insurance premiums, or we negotiate a lower rent of about 5% each, then they will decrease the costs. But the biggest component of the changes in this profit and loss is really those trade adjustments that we made previously. So the 10% increase in revenue has made quite a significant impact on this, on the profitability of this business. So you can see the net surplus, or the net profit, as we usually term it, has increased substantially. It's increased by $138,000 and is now in the green, or now in the black. So there's only some minor adjustments in a lot of the costs, but with say a 10% increase in revenue and managing the costs under the same framework, then it can have a substantial increase in the profitability. Now to the balance sheet. So a lot of business owners will be aware of the balance sheet, probably seen a lot of balance sheets, but maybe not understand exactly where the balance sheet fits in. We tend to see a lot of focus on the profit and loss, which is fine. But the balance sheet is important as well, because it shows us whether our business is solvent, and it gives us an indication as to whether how strong the business is, especially when we take it into account the previous periods as well. And there's some key ratios which we'll show you as well in the balance sheet. So in this example for Foods Co, you can see that their equity position is negative, which means that they've got more liabilities, which is down here, 853,000, than they do assets. So assets are usually things that we own or are entitled to, for example, trade receivables or debtors, and liabilities are things that we need to pay out in some way, shape or form, whether that's to the ATO or to the banks for our finance loans, or even money owed to us as the owners. So you can see that this is quite a weak balance sheet position, but this could be one of the first years of trading for this business. So that may improve over time. So again, total current assets and total current liabilities have highlighted here. The concept around current and non-current is current assets and liabilities are ordinarily those that are either receivable or payable within the next 12 months. And anything that's owing or owed to us beyond 12 months would be considered as non-current assets. So you can see a lot of our tax obligations are current, and a lot of our finance leases and loans are non-current. They may be 2, 3, 4, 5 years and beyond until we have to actually make those payments. So some key ratios in this balance sheet, or in balance sheets in general, one of them is debtor days. So debtors divided by our total sales times by the days in the year will give us an indication as to how quickly we can turn our credit sales, our trade debtors, into cash effectively. So on average, this business takes 26 days to send out an invoice and receive payment for those invoices. Now, if our credit terms are 30 days as standard, 26 days is pretty good as an average. If our credit terms are 7 days, then we need to improve our collection process in here. And we can also convert that into, we can also determine if we make a 5-day improvement on that collection, how much extra cash will it generate within the business. So that's the, we will have almost $14,000 extra in our bank account if we can bring our 26-day collection period down to 21 days, for example. And it's in a similar way, we can do an inventory conversion ratio as well. So the inventory balance divided by cost of sales times by the days in the year. We can understand how long does it take for us to buy stock or buy inventory and convert it into a saleable product or convert it into money. So in this case, in this business, from the day they purchase their stock from their suppliers to the day they invoice them out to a client or sell them to their customers, takes 74 days. Now, in many businesses, 74 days would be okay. In a food manufacturing business, 74 days is probably quite long, especially given the shelf life of a lot of food. So they've clearly got a lot of lockup in inventory in their warehouse that they're not converting into revenue quickly enough. Again, we can work out if we drop that by 9 days, in this case, that will lead to an extra almost $8,000 in our bank account over the period of a year. So we can play with these and do a bit of sensitivity analysis and work out what the dollar impacts of those changes might be. One of the most important ratios that we use is the current ratio. So it's current assets divided by the current liabilities. And in this case, this business has 0.85 to 1 ratio. So what that means is for every dollar of current obligations going out of the business, they only have 85 cents to pay those off. So we would want to look at improving that wherever possible. Ordinarily, you want the ratio to be at least above 1. A strong position in most businesses will be 2 to 3. So if you can have twice the amount of money coming in over a short term than going out of the business, that's quite a strong position to be in. And that does include our trade debtors, remember, as well. So it's not just the cash on hand. Statement of changes in equity is the next financial report. So what this shows is effectively it reconciles our equity balances within the business over a period. So in this case, you can see that the opening balances are negative and we've made losses in the last 2 financial years, which means that our equity has decreased over that period. If we're making profits, then our equity would be increasing. And if we were paying out dividends to our shareholders, that would again reduce equity, but it would be reducing equity in a positive way in the sense that the business owners would be taking money out of a profitable business. The next one is the shareholder current account. What this report effectively says is it reconciles what money is owing to the owners of the business or owed by the owners of the business. So when many businesses start out, the business owners, like ourselves, put money into the business and we expect those to be repaid over a period of time. So the shareholder current account will reconcile what those balances are at any one time. So in this case, we can see Mr. J. Doe is the one business owner in this business. It's got his opening balances at the start of the respective financial year. He's introduced some funds into the business from his personal bank accounts, but he's also drawn out cash of around $8,000 a year. And he's also paid personal life insurance premiums out of the business as well, which means that he's drawn $9,000 out of the business each year. And so that's why his shareholder current account is going down each year. So it started at 32 grand at the start of 2019. And at the end of 2020, it's $21,000. So effectively, in a wind up of this business, he would be owed $21,873 being money he's put into the business net of money he's taken out of the business. The next report that we often see in our financial accounts is a fixed asset register or depreciation report. So these can be quite short or they can be very long, depending on the number of assets that we have in our businesses. So depreciation allows us to spread the effective, over the effective life of the asset, the cost. Just bear in mind that when we're talking about depreciation, there often is differences between how we account for depreciation in the financial accounts versus how we account for depreciation in the tax return. So this is where the instant asset write-off comes into play. So you can have a situation, and you often have a situation where you actually have two fixed asset registers, one in the financial accounts and one in the tax return. Effectively, what the financial or the fixed asset register does is it tracks the cost of our assets, what the opening value is at the start of the year, whether we've purchased or disposed of assets, how we're depreciating them over what effective life and what depreciation rate we're using, and what our depreciation expense will be for that respective year in the financial accounts or the tax return, and then what the closing balances are. So you can see here the van, which is the asset at the top. We purchased it for $22,000. The opening value is $7,846, and our depreciation expense for the year is $2,354. And at the end of the year, we've still got $5,492 of depreciation to claim on this van in the financial accounts. And what this allows us to do, you'll see there's some assets with some very small numbers, in particular the office equipment. It allows us to write off maybe some assets that are obsolete and no longer actually being used by the business as well. So fixed asset register or depreciation schedule. Now, probably one of the most important parts of the financial accounts or financial reporting in general is the difference between profit and cash. So we have a famous saying that accountants often use: turnover is vanity, profit is sanity, and cash flow is reality. So what that effectively means is a lot of people look at their turnover or the revenue they're generating and saying, okay, we've grown our top line, or our revenue is increasing. But the profit might actually be reducing. If our expenses have gone up, our profit may actually be less. And at the end of the day, just because we've got profit in the business does not mean we have a cash at bank that's going up. So you can have this scenario where you've got quite a profitable business, but cash at bank is actually going down, and it's a common question we get. Now, just some of the common areas or transactions that affect one but not the other in terms of profit and cash. The first of all is GST. So when we make our payments of GST to the ATO, this affects our cash at bank because we've got to physically pay the ATO, but it doesn't impact on our profit. So this is where our profit could be higher, but our cash at bank could be lower. Another one is loan repayment. So when we're making our loan repayments, our cash at bank drops when we make that loan repayment, but our profit doesn't change. So that's a cash only item. Our interest on loans, when we pay our loan repayments, which are usually include principal and interest, but can be interest only, they will affect both. So the interest component on your loans will reduce your profit because it's a tax deductible expense ordinarily in our businesses. And it clearly reduces our cash at bank balance as well. When we go out and purchase assets, so if we purchase a new van, for example, that's going to drop our cash balance if we're paying in cash rather than taking on finance. But again, it does not impact our profitability, not at the time of actually purchasing the asset. Asset sales, the same. Our cash at bank will go up if we sell something on cash, but it won't impact on our profitability when we sell that vehicle. The component of asset purchases and sales, or a subcomponent of those transactions that will impact on profit, will be depreciation. So when we depreciate those vehicles over their effective lives, as we mentioned earlier, that reduces our profit because it's a business expense, but there's no cash outflow for depreciation. We've already paid for the asset, maybe even years ago. We're reducing our profit and sometimes reducing our tax as well. But our cash at bank doesn't change as a result of depreciating an asset. So with those items in mind, you can clearly see how, and there's many other examples as well, you can clearly see how profit and cash in many instances, if not most instances, won't be the same. Now, I wanted to talk about the Business 101 cycle. So the typical cycle of a business, first and foremost, is us as business owners start a business and we invest in our business. So that's usually in terms of investing cash from our personal bank accounts, but also our time as well. And then by using those funds in our business, we purchase assets. So whether they're vehicles or plant and equipment, or even we're paying for staff who are an asset, not a cost, we purchase or pay for assets that generate income within our business. Now, oftentimes there's money coming into the business as a result of financing some of these assets as well. So we're getting money in from the bank to accommodate that as well. And then by using those assets effectively, we generate income, which hopefully generates profit or a return on those assets. So, and that's the goal of those assets, is to generate enough income to cover the costs and provide a profit or a return. Now, things that increase profit is our growth in sales and our growth in our margins, or our gross profit. The items that drain or reduce profit are things like overhead expenses that are left unchecked, and we continue to incur them, even if we don't necessarily need them. And especially with a lot more subscriptions in our businesses now, it's a lot easier to continue to pay for something that we may not be using anymore. And then as a result of generating profits in our business, that generates cash. So our cash at bank should be going up if we're generating enough profits to compensate for our other tax and finance obligations. And then what happens is that cash is again reinvested somewhat into the business. Now, things that reduce cash flow are if we're collecting on our trade debtors slowly, business loan repayments, tax payments, as I mentioned, and sometimes we might be paying suppliers quicker than we need to on credit terms as well. Things that increase on cash is the quicker collection of our credit sales or our trade debtors, not having too much of a lockup in stock or work in progress, and reducing our tax payable wherever we can. So paying less tax legally where possible. Now, with that cash, we reinvest part of that back into the business, and the cash is reduced, or the reinvestment into the business is reduced, whereby we can start paying off some of those personal loan repayments. So if we've contributed money to the business and we want to start paying ourselves back, then that's going to reduce the amount we can reinvest in the business, and drawings as well, where possible. So drawings and personal loan repayments, there's nothing wrong with them. It just means that we've got less to reinvest in the business. And at the end of the day, the faster we can cycle through these 4 stages in our business, the quicker we're going to increase the return on investment, or our personal return on investment in our businesses, and the more money we're going to make, or the more, I guess, the less stress we're going to have around our businesses. So the quicker we can get through this cycle, the better. And we continue to cycle through this every day in our businesses. Now, the key drivers in our business, they're going to be different for every business. So every industry is different, but the importance is you need to know what your key drivers are. So whether that's monthly recurring revenue, whether it's increase in sales, or maybe it's having less clients, but charging them more, so having more revenue per client. So you may have a model whereby you are happy taking on less in terms of clientele, but you're charging them a good price and you're doing a lot for them. So it's not always about acquiring new clients all the time. For some businesses, that's going to be important. Client growth is going to be a key driver of business value. We just need to understand what our 3 or 4 key drivers are in our respective business and really focus on those areas. Now, one of the other parts of growing a business is understanding what our business is worth as a value. So if we wanted to sell it in the open market, we want to understand what we get for it, and how we go about increasing that. So in terms of increasing business value, first of all, we need to make sure we have clear business plans and clear goals and key performance indicators for us and our staff as well. So the clearer we can map that out, the better. We need to make sure we're defining and documenting who does what in our organization, including what we do ourselves as owners. And the ability to have real-time reporting using cloud-based software like Xero and MYOB and QuickBooks and the like, that allows us to make quicker decisions and allows us to make more informed decisions as well. The other thing is when we're looking at selling a business in the open market to a third party, you're going to get a higher business value if you have well-documented systems and processes and the business is less reliant on us as owners. So if your business is one where you can sell to almost anyone and it's a turnkey type solution, then you're going to demand more in terms of value in the market. And also managing and identifying risks. So if you've got a business that is can be taken on and run by anyone and it has low risk, then you can see the value of that business is going to be higher. So they're the 6 areas we need to focus on to enhance our business value, not just about building and not just about improving the profitability. Now, in terms of protecting our assets, there's a few key areas that we advise on, and some of these can be fairly simple to implement. So the first one is limitation of liability. So ordinarily, if you're set up as a company, your liability is going to be less than if you're operating as a sole trader or a partnership because of the overarching Corporations Act and the fact that you're limited to the liability of your share capital in that company. The next one is directorships. So consider who should be a director of your company and which assets are held personally by the directors, or maybe which assets are held by our non-director spouses. So oftentimes we see one partner in the family is running their own business and one might be working for someone else as an employee. And oftentimes we advise on having maybe the main residence or the home in the spouse's name who's working as an employee, because they're less likely to have risks as a result of running a business, or that they're not going to have that risk at all. Security of loans. So most loans nowadays you can't get away without having security unless you want to pay a lot higher interest rates. But just make sure that wherever we're providing loans to other people, maybe friends and family, that we're providing for security over those loans. So securing assets over those loans. As I mentioned, ownership options for high value assets. So this is maybe we have high value assets of our business sitting in a separate company or a separate trust, and we're leasing or renting those assets back from that entity, just to reduce the risk if something was to happen within the trading organization. Make sure we've got our updated terms of trade and credit policies up to date, and that the customers are signing it and are aware of it. That protects us in case customers were to make a complaint about our terms of trade and credit. Reviewing our insurances, making sure we've got enough professional indemnity, business interruption insurance, and also personal insurances as well. So your life, total permanent disablement, and income protection insurance as well. We recommend looking at working with financial planners to understand what your personal goals are. So whenever we're setting our business goals, we always make sure that our business goals are set in line with our clients' personal financial goals. And that's really where financial planners can help. They also will help with that life TPD and income protection discussion as well. One of the big ones we see that's hasn't been put in place or has not been updated for a while is estate planning. So these are your wills, your powers of attorney, testamentary trusts if required, and really documenting how you want to pass your assets on to your family if something was to happen to you or a family member, and particularly who will gain control of your business if you were to pass away. So very important. Oftentimes we see young people don't do their wills and estate planning, but remember most wills or all wills should deal with things like guardianship. So even though our businesses might be small and haven't grown to a mature size yet, we do need to take into account things that what happens to our young children if something was to happen to one or both parents. So in terms of adopting best practice business governance, we recommend all businesses should have an annual business plan, an annual forecast, and the forecast should include the cash flow implications, not just the profitability implications. So remember, we spoke about profit is different to cash. Oftentimes we have profit budgets, which are better than nothing, but we would always recommend having a cash flow forecast to really understand where our landing point is in terms of cash flow over the year, wherever we can. And also ongoing reporting and accountability. So whether you're a sole business owner or you've got a business partner, we recommend both keeping each other accountable, but making sure you've got someone external to keep you accountable to your goals as well, whether that's a spouse or a friend or a professional advisor, and making sure we're going through regular financial reporting to check in and see whether we can identify any risk areas before they become big issues, as we mentioned earlier. And knowing your numbers is just the beginning. So we've gone through the financial reports and understanding the financial figures, but at the end of the day, it's what we do with those numbers that's the most important, and what insights we can obtain from those reports or those figures. So what I'm going to do now is I'm going to hand back to Ross to take us through the next couple of slides.
Thanks, Warwick. Huge appreciation to you for going through that fairly heavy content. We hope that for all the attendees, you found it informative and you've found a few takeaways for yourselves. The biggest thing we want to encourage you to do is to implement something out of what you've heard today. So we would strongly encourage you to get started now and write down 3 actions or projects that you feel will add value to your business or give you some peace of mind as you head into the holiday period and then kick off the new calendar year. We're all, I'm sure, looking forward to 2021 being a little bit more productive and a little less disruptive than 2020 has been. As we always sort of say, we get excited. A problem is an opportunity to create a project and derive some improvement. And further, that doing nothing shouldn't be an option. We feel that for business owners that want to sort of sit and hold tight and hopefully the same continues, it's not a fantastic strategy. We always encourage you to doing something about improving your business and freeing up time for yourself to work on it. We love nothing more than helping our clients to do that if we can. There has been a couple of questions populated through the webinar, but not a huge amount. What you can see on the screen now is just a few different ways that we do help clients who want to get more out of their numbers and start to really generate positive improvement within their business, ranging from complimentary review meetings to discuss where you feel your business is at and what might need to happen next, through to valuations, mentoring, forecasting, and reporting. What I'm sure you'll appreciate from that is that Warwick from the webinar today is that Warwick's a whiz with the numbers through your financial reporting framework, but it takes many years and a lot of training and study through university and CA programs to sort of understand that in full depth. We do truly hope you've got a better understanding from today. But if there's areas you do have questions about, please start throwing those up now if you have them, but always know that we're here to answer questions at any time if you have them, so please throw them to us. If we'll leave that a couple of minutes to populate. But we do want to thank all the attendees for attending our first webinar, hopefully first of many. And also to be on the lookout, our next one we're scheduling for February of 2021. I'm looking forward to that. What I might do while I wait to see if any questions come through in the next couple of minutes is just to reiterate the ones that were asked. The first was, is the recording, is the webinar being recorded? It is. As much as I'm going to ask for some assistance from our office with the technical side of it, we will email the recording out shortly after the webinar is finished. And another reminder that you'll be asked to give us some feedback post the webinar, which we'd really appreciate if you could take a minute or so to fill that in for us so we can get your responses. That'll be great. Quick question there from Rachel. To book a session, how do we contact you? Through our website, there's a link available to book any meetings that you'd like. That link is also available at the bottom of all of our email signatures, but always love to hear from you. So if all else fails, please feel free to email or call the office and we can try and schedule meetings in with Warwick and myself. One of the other questions we were asked through the session was when Warwick was talking through the trading account statement, the top section of the profit and loss, and how to allocate direct costs and cost of sales appropriately. It's all well and good for all the numbers to get tracked through your accounting systems, but how do you get the reports to tell you the right things? With the advent now of Xero and cloud-based accounting platforms, there are ways to set up the background of it to provide you that information. So one of the questions there was, I want to be able to allocate my direct wage costs appropriately so it impacts the gross profitability and I can see the impact of it. Within Xero payroll settings, there are background pieces where we can establish separate allocation and then on an employee by employee basis, allocate some or all of their wages at direct costs or operating expenses and overheads. Fairly straightforward to do, but not something that everyone would do on a daily basis. So if we can assist with that, please let us know. I can't see any other questions popping up now. We'll send the recording out, as I mentioned. You will hopefully have the notes. If anyone hasn't received those, please do contact us through hello@advisory.com.au. But with no further questions, what I'd love to do is to say a huge thank you to Warwick for presenting today. And a huge thank you to all of you as attendees for joining us. We wish you all a very safe and happy holiday period and all the best with planning out those next 3 actions for yourself that you're going to implement into your businesses. But I'll leave you all there to get on with your days. Thank you very much.
Thanks, everyone.